Many of the discussions I have with my clients are about risk, how you can calculate it and how you can manage it. But the most important thing is to understand exactly what the risks are, because only then can you start to get a handle on how you can control them. So in this video, we're going to look at that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. These are the 6 different types of risk we're going to look at, and we can start with price risk. Now, over the long term, equity prices tend to drift upward, as has happened for the S&P 500 between 1990 and 2019. But you can see it's not a smooth ride. You get many periods when the price falls quite sharply. And the jaggedy appearance of this price graph shows that the price fluctuations are quite large. And that's why we look at the typical daily percentage price move of an asset as a measure of its price risk. And that's also called its volatility. In the US, they use options to describe an index which is called the VIX. Some people call this the fear index, because notice how when the stock market falls very sharply, the value of VIX rises very sharply. And in 2008, it rose above 80%. But when stock markets are rallying very strongly, notice how the value of VIX tends to fall. And most recently, although we have had some sell-offs, the level of VIX has been fairly low. And that's because prices have tended to rise quite sharply. In the UK, we don't have such a liquid options market as there is in the US, so we haven't got a FTSE 100 equivalent of the VIX. But what I've done here is to plot the actual volatility, which is the average daily percentage price move averaged over the last 30 days. And you can see how it corresponds with most of the spikes in the S&P 500. And if I do the same for the FTSE 250, again, you can see that the spikes line up. And that reflects the fact that global equity markets tend to be highly correlated. They tend to move up and down in sync with one another. And that means that they also fall at the same time. Now, the simplest way to reduce the volatility of your portfolio is to buy assets which have a low volatility. And typically that would be developed market government bonds. Those are bonds that might be issued by the UK, Germany, the US, or Japan. If we compare that with a 100% equity portfolio, notice how the capital gains for equity tend to be much higher over the long term. But that comes with a huge amount of price volatility. But it's not just a binary choice. You can have any combination of equity and bond in a portfolio. The more equity you have in a portfolio, the greater the price risk. And you can dial that risk up and down very easily by adjusting your asset allocation, which is how much money you've got in equity and how much money you've got in bonds. But you might be thinking, why would you ever want to put any money into bonds? Their return tends to be very low. Why not just put everything into equity? Well, let's look at this period in 2016 to see what happens in an equity market sell-off. During this period, equity fell by 19%. Whereas bonds did a good job of maintaining their value. They only fell by 3% and recovered quite quickly. So one reason why we put some of our money into bonds isn't to increase our capital gain, because that comes mostly from equity. It's to preserve our capital in the event of an equity market sell-off. And some investors just couldn't weather a very sharp drop in equity. So for example, if you have a very short investment horizon, perhaps you're about to retire, or you could just be very old. You don't want to have that risk that when you need your money, it will have sold off. So for that kind of investor, you may want to have a lower equity allocation and more money in the safer bonds. For the 100% equity portfolio, the volatility is about 11.5%. Now, if the thought of losing 12% of your capital in a typical year fills you with dread, then a 100% equity portfolio probably isn't for you. So another reason why people don't have all of their money in equity is that they just don't have the appetite for that kind of risk. They sleep much better at night knowing that they're taking a much lower level of risk. And in this risk-return plot, we look at both the risk on the x-axis, with very high risk on the right and low risk on the left, alongside the return on the y-axis. So we have low returns at the bottom and high returns at the top. Now, in an ideal world, we'd have assets which gave you both a low risk and a high return. But in practice, what we see is that assets which tend to give you the highest risk also give you the greatest long-term returns. But of course, that's not guaranteed. That's why it is a risk. During some periods, equity markets and other risky assets sell off very sharply. But these risk-return plots are very useful because they let you compare assets to show you exactly how much risk you took to get a certain level of return. And if we're comparing two assets which have the same return, you'd prefer the one which gives you that return for a lower level of risk. Here's the volatility of a wide range of funds offered by Vanguard in the UK. The riskiest one is the Emerging Markets Equity Fund at the top, which has a volatility of 16.5%. The S&P 500 isn't far behind at 14.3%, and then we go through Asian equity, and finally we come to government bonds. The most risky of those is the UK Long Duration Gilt Fund. Notice that the normal government bond fund, which has shorter duration, is lower risk, but we'll come back to the reasons for that later on. For the lowest risk government bond funds, you can see the volatility is extremely low. So the typical annual percentage price move of these funds is absolutely tiny, but so is their capital gain. Now, one way to look at correlation is to use this tree, which we call the Scooby-Doo tree. You can see how it splits the universe of assets into low-risk assets at the top, which are mostly government bonds, but also corporate bonds, and riskier assets, which are at the bottom, which are equity. And I like to characterize those as being like characters in Scooby-Doo. So Velma is kind of boring, let's be honest, but she does offer the concept of safety. Whereas Scooby-Doo is kind of crazy and wild, and he provides all of the action, kind of like equities. So you can build a portfolio with just one fund from the top, from the low-risk assets, from the bonds, and one fund from the bottom, which are the Scooby-Doo exciting assets, which is equity. But most importantly, what you don't want to do is to buy two funds which are close together in a tree, like US Treasury bonds and US corporate bonds, because those tend to be highly correlated with one another. And if they move up and down together, they'll double up the risk of your portfolio. So one of the services which I offer to clients is to look at the correlation of their assets. They specify which funds they own, and then I can do this Scooby-Doo tree, and then we can quickly see whether they're doubling up on their risk or whether they're not. So to get rid of price risk, you can just choose assets which have low volatility. And you can use diversification, which uses the fact that assets which move independently tend to cancel one another's volatility out partially, and that reduces the overall volatility of your portfolio. The next risk we'll look at is political risk. This is the Financial Stability Report from the Federal Reserve in the United States, published in May 2019. And this shows the percentage of the analysts which cited each shock. And the most cited risk by far was trade frictions. And the second risk is kind of related to all of them, because if the Fed responds incorrectly to the global risks, that could severely damage the US economy and consequently the global economy. And the country which is in the crosshairs of the trade frictions at the moment is China. And if we have a sharp slowdown in China, again, we're going to get global impacts. Global equity markets now sell off when China sounds like it's in trouble. And the fourth risk, which is the UK's contribution, is Brexit. So focusing on the trade tensions, this is a quote from that report. US-China trade relations were the focal point, but there's also now the threat of US tariffs on imports of European autos and parts, and in particular that's going to hurt Germany, which relies heavily on exports of its auto manufacturing products. But the analysts also worried about a generalized slowdown in growth, particularly in China and Europe. And there are also unfavorable political dynamics in Europe, in particular no-deal Brexit, and the age-old problem of the Italian government spending too much. They call this fiscal tensions. There was a great report by Chad P. Bown from the Peterson Institute called The US-China Trade War, The Guns of August, where he has this lovely timeline showing the increased tariffs on Chinese imports to the US. And by December 2019, the size of these average tariffs is going to be about 27%. But what's even more dramatic is if you look at the percentage of US imports from China covered by these special trade protections. And that's going to be almost 100% by the end of 2019. And the market reaction to these increase in trade tariffs has been unequivocal. It's bad for equity. And as the trade tensions ratchet up, markets pull back. You can think of this as a trade war on state of markets, where equity sells off and bonds and gold rally. And in the trade war off state, equity rallies and treasuries and gold sell off. The difficulty with political risk is that it's almost impossible to hedge. Do you take risk off the table by selling your equity and buying bonds? The risk then is that there's a resolution of these trade disputes, and then equity would rally strongly and you'd be wrong-footed. So the best thing that can possibly happen is for this to be resolved as soon as possible. Next, let's consider interest rate risk. Now, the reason why we call bonds fixed income is that they're precisely that. You pay £100 for a bond on the day that you buy it, so the cash flow is negative. Then after 1 year you receive a £1 coupon, say. After another year you receive another £1, and in the final year for a 3-year bond you get your final coupon of £1 and you get your £100 back. So if this is issued by the UK government, it's called a gilt, and you can be almost 100% certain of when you receive those cash flows and exactly how much cash you receive. And that's why the volatility of bonds is very low. You know exactly what you're going to get and when you'll get it. But it still comes with a risk. Now, when the bond was issued, the cost of borrowing for the government over a 3-year period was 1%. So it was absolutely fair that the coupon should also be 1%. But what happens if just after we buy the bond, rates suddenly spike up to 2%? Well, suddenly that doesn't seem fair. We're losing out on £1 per year for 3 years. And that means that the price of the bond will fall by £3 or 3%. So because we fixed our level of interest at the issue date of the bond, if rates go up, the price of our bond will go down. And that's why there's an inverse relationship between the price of a bond and its yield. And that's where interest rate risk comes from. But it can also act in our favour. So if instead of rising, interest rates had fallen to 0%, as they have in many developed market countries, then everybody else would be getting 0 coupon. And our bond suddenly looks very attractive because we're getting £1 when everyone else is getting nothing. And over the course of 3 years, we get £3. So the price of our bond would increase by £3 or 3%. Now, if we'd have locked in the period of borrowing for more than 3 years, say 5 years, then the benefit would have been even larger and the price of our bond would have risen by 5%. So the lifetime of the bond affects its risk. And that's why we always think about the duration of a bond in years. The bigger the duration, the bigger the interest rate risk. So here I've compared 2 bond funds. In red, we've got a normal gilt fund, which contains gilts of all maturities. But in green, we've got a long duration gilt fund. Notice how the volatility is much higher than it is for a normal gilt fund, but the return is also higher over the long term. And that's the compensation we get for taking that term risk. But greater risk is a two-edged sword, as we can see in this period in 2016, when rates increased quite sharply and the price of bonds fell. The gilt fund from Vanguard has an average duration of 14 years. But the long duration gilt fund only buys longer dated bonds, and that has a much higher duration of 20.7 years. So its interest rate risk is much higher. And if we focus on that period in 2016, that risk becomes very apparent. The normal gilt fund, which is in red, only loses about 8% of its value, whereas the long duration gilt fund loses much more, about 15%. So we can control the duration risk of our portfolio by changing the maturity of the bonds that we buy. If we think rates are going to go up, then we want to minimize our loss by having shorter duration funds. And if we think rates are going to fall, then we want a portfolio which has as large a duration as possible to amplify that gain. And I'll take that opportunity to plug my bond fund course, which contains 5 videos which help you learn about the different types of bond, but also the funds that give you exposure to those types of bond. And you can find that on our website, PensionCraft.com, under courses we offer. The next risk we'll consider is credit risk. And here we'll look at an example which is Thomas Cook, which was a UK travel company. And on September the 23rd in 2019, it announced that it was going to enter into compulsory liquidation. Now what that means is that it was going to sell its assets and pay off its creditors. The share price of Thomas Cook has been falling fairly steadily over a very long period of time, recovering in 2013, but then finally falling to 0 as it announced its liquidation. So shareholders in the company would have lost everything. So it pays to remember that equity investors also have credit risk. But there were also many bondholders for Thomas Cook because it had issued a very large amount of debt. But that was a huge drag on its profits because it had to pay very high interest payments. And here's one of those bonds. It was set to mature in 2022, but of course it didn't make it because it defaulted before then. The bond was denominated in euros, and during 2017 and 2018, you can see the price was above €100. But as Thomas Cook's credit risk increased, the price fell, and as it grew ever more probable that there was going to be a default, the price of the bond fell further, until it reached just around €7. But the bondholders probably will get some of their money back. Usually for investment grade companies, which are rated BBB and above, the recovery rate for the bonds is around 40%. For junk bonds, it's usually around 20%, but it's very variable. And it really depends on the quality of the assets and also the amount of debt which has been issued. But generally, it's much higher than the recovery for equity, which usually gets completely wiped out. And that's because equity is lower in the capital structure than debt. Now, the yield of one of these bonds, which was issued by Thomas Cook, was fairly low, well below 5% during most of 2017 and 2018. But then as the credit risk started to deteriorate, investors demanded a much higher yield to hold the credit risk. And if you're a pension fund or a hedge fund, you can buy this credit insurance on individual companies called a credit default swap. And the premium on that credit default swap is a direct measure of the credit risk of the company. So it was hardly the case that markets didn't see this default coming. You'd have had plenty of time to pull out once you'd seen the warning signs. Now there's an incredibly useful resource if you're a credit investor, and that's the FRED database. It's completely free, and you can look at thousands of variables from the US economy, including the spread on their bonds. Now the credit spread is a measure of credit risk, and I've plotted it here for two ratings. BB bonds, which are junk bonds, and you can see their yield is very high, and you can see the credit spread spikes during periods of credit stress, such as in the global financial crisis, and it peaked above 12%. Whereas for investment grade bonds, and here I've looked at the AA rated bonds, the spread is much smaller. You get a much smaller compensation because you're taking a much smaller credit risk. And even during the financial crisis, the AA spread never went much above 5%. So this provides a really timely way to look at credit stress in the US. And at the moment, you can see that those spreads are very tight. And that means that there's very little sign of credit stress at the moment. But these credit spreads are also interesting for equity investors, because it's often the case that the credit markets sell off and these credit spreads spike before equity markets do. So you can think of these spreads as a kind of canary in the coal mine. Sometimes they give you a warning of trouble ahead. So it's certainly worth looking at them. Another useful report, which is also free, is a Global Financial Stability Report produced by the IMF. They produce all sorts of measures. Here they're looking at the rate at which BBB bonds, which are just one notch above junk, get downgraded to the junk category. During periods of credit market stress, such as when the oil price fell in 2016, that rate of downgrades increased very rapidly, and many energy companies in the US defaulted. But as of 2018, the rate of those downgrades was very low. But of the two measures, the credit spreads will be much more reactive. They react on an almost daily basis, whereas credit downgrades take a while, and the warning from credit downgrades may come too late to get out of the market. If you're a long-term investor, inflation is incredibly important. To see why, we can consider the price of a loaf of bread. Statistical agencies measure the value of consumer goods in order to construct these inflation indices. Here's the year-on-year change in the price of a loaf of bread since 1970. It's extremely volatile, but the typical value is an increase in price of about 4%. So to see what that means in practice, let's see what would happen to the price of a loaf of bread over the next 40 years. In 2019, as I make this video, the price of a loaf of bread is about £1.40. But in 2059, in 40 years' time, that'll be worth £6.22. Now, if the rate of return on my investments doesn't keep up with the price of a loaf of bread, or more generally the inflation index, then in real terms, in terms of its buying power, then I'm losing wealth over time. So inflation provides me with a hurdle that my investment returns must beat. If they don't, I'm going to be losing money in real terms. The Office for National Statistics constructs a consumption basket, and that measures a wide range of prices for the typical UK consumer. Here are the weights in 2019 for the typical goods and services consumed in the UK. Housing and household services make up the biggest weight, of around 30%. but transport and recreation and culture are also very important. And the consumption basket is far from static. So in 2019, smart speakers such as Amazon Echo and Google Home were added. And after the huge success of the Great British Bake Off, bakeware has also been added to the consumption basket. In red, you can see the UK CPIH measure, which includes housing costs. Now, the Bank of England's target is to keep inflation at 2%, and the median over the period since 1990 has been around 2.3%, so not far above that target. But if we look further back in time, using the RPI index, which is an older methodology for inflation, you can see that it got hugely out of control, rising for a short period above 25%. So this makes it really clear that central banks are extremely important. It's their job to ensure stability of the currency, that inflation doesn't get out of control as it did in the 70s. So I think we should be a little more appreciative of what central banks do, because without them, we could see inflation returning to these crazy levels. So let's hope that they do a good job in future and they leave us a very low bar for our returns to beat. Now, if you want a hedge for inflation, index-linked gilt funds provide that hedge. The value of those bonds is linked to the level of inflation as measured by the ONS, and you can buy exposure to those through fairly cheap exchange-traded funds, such as these offered by iShares. And here's an equivalent fund from Vanguard, the UK inflation-linked gilt index fund, which also has a very low fee of 0.15%. Now, some people say that gold is a good inflation hedge, but if you look at the data for that, it shows that gold is a very poor inflation hedge. Inflation-linked bonds are a lot better, although they do come with a risk, which is that they have a very long maturity. So the duration tends to be very high, above 20 years. And that means you'll still be exposed to fluctuation in the levels of yields. But they do provide that all-important direct link to the level of inflation. And as you get closer to retirement, you probably want to at least consider incorporating some index-linked bonds into your portfolio. The final risk we'll look at is currency. Here are the returns for a selection of funds during the 2-week period following the EU referendum. And during that period, the value of sterling fell very sharply against other currencies. The largest returns were for funds denominated in US dollars, in Japanese yen, and in euros. And the smallest returns were for sterling funds. So there was a very clear split for foreign currency assets, which rallied strongly, and sterling assets, which didn't. Now, the reason for that is that when sterling weakens, that increases the value of foreign assets when they're sold and converted back into sterling. And if sterling strengthens, that reduces the value of foreign currency assets. So if you do think sterling is going to strengthen, you can either hold more sterling assets, but that would reduce your diversification, or instead, you could currency hedge your foreign assets. Here's an example of a currency hedged fund. It's managed by iShares and it's buying US Treasuries. But as you can see here, it's sterling hedged. So the fund provides you with targeted exposure to US Treasuries. But if we look at the currency exposures, you can see that it's all exposed to sterling, with almost no exposure to the US dollar, whereas the benchmark which it's tracking has no exposure to sterling and 100% exposure to the US dollar. And what that shows us is that the hedge is doing its job. It's removing that currency risk. So it is possible to control the risks in your portfolio, or at least most of them. Political risk is particularly problematic, but the one risk I didn't mention is that some people don't take enough risk. If you're a long-term investor and you just buy very safe government bonds, it'll limit how much money you can make over the long term. Of course, taking more risk doesn't guarantee that you'll get better returns, but not taking enough risk over the long term guarantees that you won't get good returns. Now, if you found that video useful and you want to see more of these videos, please support us on Patreon. We rely completely on you for our support. It costs just $5 a month, and you get to join us on our Slack channel and also to join our Sunday evening live calls, which are very friendly and interactive. So, as always, thank you for listening.